Hi everyone, welcome to the next presentation by myShares for the Electronic Trading Club. This presentation deals with just buy the frickin' dip. Should I focus on longs only? We will look at the different markets in the world and apply this mantra to see if it's really the case. We go through some charts, some ideas, and finally put this saying to the test by looking at actual results of systems. Here are the topics of discussions. We go through some background, we go through the markets and system results. Right, so let's get started. Federal intervention has been around as far back as 1850. However, since the year 2000, it has practically become the norm. The Reserve Bank continuously steps in to save the markets, however ultimately causing a new bubble, as they teach the markets that they will always come to the rescue as bad behavior is rewarded. So many traders have tried shorting the markets, losing a lot of money, and others have gained the mantra, just buy the frickin' dip. Markets also generally tend to have a bias towards going up, so it leads to the question, should I focus on longs only? Now let's have a look at some of the markets to see if this is the case. Firstly, here's the Aussie. The two major crashes since 2000, here and here, have been highlighted in red. The chart obviously stands out to only go up, besides the two small blips on the screen. Easily we can say longs is obviously the right call for the past 15 years. Next, the S&P 500. This was an analysis I found about a year ago that I quite enjoyed. It's definitely worth a while to go through this analysis. The video does not show enough definition, so you would have to download the PowerPoint file to go through it. But it's definitely worth it. But to get back to us, the indicator is called the super trend. In hindsight, it worked very well in the S&P for end of day systems. Again, we can see buying the dip in the cases panned out quite nicely most of the time. You can see here's an uptrend, a nice uptrend, and again another uptrend. Why does it seem that the markets only go up? Well, simplistically speaking, of course, two drivers of this is that firstly, inflation naturally pushes prices up. As prices rise over time, so does earnings. Inflation is obviously not as simple as that, and you can really get into debates with economists with this. The other driver is that in indexes, the better performing companies will get pushed in naturally, and your poorer performing companies get booted out over time as companies grow and shrink. I'm not getting into fundamental speak too much here, as it's outside of our scope. However, this just touched on some basics. So let's apply this now to other markets, just to make sure we've looked at everything. Starting with the Nikkei, just by the... Wait, how long is that dip? The Nikkei went into a 23-year bear market, starting in 1989, here, and considering it hasn't reached new highs, it's technically still in a bear market. So that means when you bought, if you bought when you were say 20 years old, then you would still be holding at the age of 45 with a loss. Okay, what about Forex then? Forex trends can last for some time in the market. However, it doesn't follow the same rules as equity markets, as countries don't necessarily grow like a business every year, or even if they do, they might not outpace the opposite side. Like in this chart, the euro-dollar, there were times Europe was doing better and other times the USA were doing better, just in comparison. What if we moved over to commodities then? Here's a chart of gold. It seems to have some nice rallies since 1970, as you can see over here and here. However, in between there was a 25-year bear market. So not having done so well with Forex and struggled a bit with gold, obviously the answer was to go back to equities. Let's go S&P! 1962 to 1982, the S&P went through a 20-year bear market. Buying the dip would have been a very difficult experience. So to summarize a bit then, I purposely showed you those pictures in that order so that firstly you realize anybody can sway your judgment in how they deliver content. Be careful of your own mind. It can also lead you to wrong conclusions. Next, we mentioned that different asset classes like Forex don't work in the same way as equities, as their drivers work on different principles. And finally, overall it does seem like equities do have an upside bias over the long run, with some short blips in recent years. So the question we need to ask is, what does this mean for our systems? Using AmiBroker for the testing, the first system is the one we know by now, the 7x13 crossover system. The top chart over here shows the returns for both long and short positions. The bottom left for longs only, and the bottom right for the shorts only. As you can see, the shorts over 5 years made almost zero returns. Most to all the money was made with the long positions in this system. Next is a system called Solanum that some of you might have heard of. It's a public system that was designed by Capital Synergy. It's the same format here. The top left is all positions together, bottom left is longs only, and the bottom right the shorts only. Besides the small bit of profit here in 2011, overall shorts were poor performers with this system. Finally, I applied the same Solanum system to the DAX market to see how it compares. Even though the profits were less on the overall results, it is still quite clear that shorts were poor performers and practically all the returns were made on the long side. The last slide on this looks at the recent crash years of 2008. The previous slides only started in 2010, so what about crash years? Surely shorts are awesome then. Here are the results on the Aussie for both Solanum and the 7x13. The testing was done for Jan 2007 to December 2009. Starting with the shorts on the right hand side, yes, the results were definitely better. Our equity curves made some great gains on the short side. What's interesting though is that so did the longs. You had some steady upward trends here, even though it was a crash period. So what is the final conclusion? What was shown here were just two systems and some charts. I'm sure there are systems that work incredibly well with shorts that I don't know about. So I wouldn't write off shorts completely just quite yet. However, what I take from this is when I design a system in the equity market, I would more try to focus on patterns on the long side rather than the short side. And if the backtesting results show poor performance on the short side, I would seriously consider not trading shorts at all, as this could save on both brokerage and some emotional pain. Now to get into the practical side of things, as we look at how to run an algo or expert advisor. I will separate this part into a different video for ease of future reference, so that you can simply view that video for the tutorial. I show you how to run an expert advisor on two separate applications. The code for both are the same as they both use MQL. The tutorial is for MetaTrader and for ProTrader and Terminal Velocity. I show ProTrader, however, the look and feel is extremely similar to Terminal Velocity. So skipping ahead, I'm going to end with some food for thought. A very famous book has been written called Outliers, which looks at studies of successful people. Malcolm Gladwell explains persistence pays off a lot more than talent. Most will try and convince you that trading, for example, is an art form. Some famous traders believe this, and it works for them. For the rest of us, it's a matter of hard work and persistence. 10,000 hours means working for 8 hours a day. It takes a minimum of 3 years full-time to get to that. Something to remember if struggling. Funnily enough, it was Malcolm Gladwell's third book that put him on the map, not his first or his second, almost proving his own point. That's the whole presentation. Thank you again for listening, and hope you enjoyed it. Cheers.